Good day to each of you and welcome to this presentation. So today we'll discuss the process of identification and assessment of risks by the auditor. I will specifically look at the ISO 315 revised 2019 version, which was changed in detail and therefore introduces a few new concepts. So to get you started and just to take you back a bit, I just want to remind you that the identification and assessment of risk of material misstatement forms part of the planning stage of the audit. However, note that this is not the only time that the auditor assesses risks, and as they become aware of them, they will go back to this stage and revise those risk assessments and change it if it's necessary. So let's just think about risks in general for a moment. Some of the risks in our personal lives that come to my attention immediately include health risks, safety and security risks, and financial risks. So the question is, what do we do about these risks? We certainly don't just leave them, but we try to mitigate them to minimize the effect that they will have on our lives. For example, if you feel sick, you will go to the doctor. Or to mitigate a financial burden, you might decide to take out insurance or save money for your old age. So just as individuals, entities and their business operations are also affected by risks. For a business, management are responsible for identifying and assessing risks that affect the entity's business, and this is also called to or referred to as business risks. Auditors are responsible for identifying and assessing risks that affect the entity's financial statements. So whenever you think about the auditor and risks, keep this in mind and also ask yourself as the auditor, what is the effect on the financial statements? This is very important. So on this slide, we have a summary of the risk assessment process. In the first two steps, it's important that the auditor ensures that he or she has an understanding of the entity's environment and its internal controls, but also the financial reporting framework that the entity uses. Only then will the auditor be able to identify and assess risk of material misstatement at the two levels, namely the financial statement and the assertion level. Through this process, it is necessary to be able to identify the relevant assertions and the significant classes of transactions, account balances, and disclosures, so that those risks can be placed on the spectrum of inherent risk to be able to identify significant risks. After all this has been done, it's important for the auditor to stand back and revise the risk assessment, and if he's happy, formulate responses to address those risks. What is important to note is that the process is dynamic and iterative, and that basically means that it's an ongoing process. Okay, so this is a summary, but let's look at the detail. So the revised ISO 315 introduced a few new concepts. You will see on this slide there are some of these that you are already familiar with, but make sure that you understand the new concepts. I'm not going to discuss them in detail, but please go through them. I wanted to draw your attention to them specifically, so make sure that you understand them. They are summarized in your lesson and they are also explained in the revised ISO 315. On this slide, I'm just giving you an overview of ISO 315 revised 2019 version, and we will discuss all of these elements in a bit more detail later on. So firstly, it's important for you to keep the auditor's objective in mind. Now, to remind you, ISO 200 stipulates that the auditor's overall objective when conducting an audit is to obtain sufficient and appropriate audit evidence to reduce audit risk to an acceptably low level. So in essence, the reasons why the auditor identifies risk is to focus and understand those risks so that he is able to formulate audit procedures to address those risks and really make sure whether or not and what the effect on the financial statements are. So the auditor should always keep an open mind and exercise his professional judgment and skepticism throughout the audit process. And that just basically comes down to always being alert to contradictory audit evidence, not always listen to management, but really look for the evidence to back it up, and then also to use the expertise when making a decision. The auditor should identify and assess risk of material misstatement at two levels, namely the financial statement level and the assertion level, and it can be assessed either due to error or due to fraud. And remember, there are two components uh, to which risk of material misstatement can identify, and that is the inherent risk component and the control risk component, and it should be assessed separately. Inherent risk should always be placed on the spectrum of inherent risk, and I will really go into a bit more detail so that you can understand this concept later on. And remember that we mentioned that the risk assessment process is iterative and dynamic, and that just basically means that it's not a once-off process. And whenever the auditor becomes aware of a new risk or something else, then he should revise this risk assessment. The revised ISA also refers to scalability, and that basically means that the auditor should take the complexity of the entity into account when identifying and assessing risks. And therefore, the process is not a one-size-fits-all for all entities. Okay, good. So how does the auditor obtain evidence when performing risk assessment procedures? So firstly, he can perform inquiries, analytical procedures on the financial statements. He can observe certain processes or inspect documentation. From where will this evidence be obtained? So he can have discussions with management or internal auditors. He can also consult regulators such as SARS. He can have a look at press releases or investor or analyst reports, which are public sources and available. And then he can also consider the information obtained when he made his decision to accept an audit client, or maybe if he became aware of information when conducting an audit of another client or from previous experience. It's just always important that the auditor makes sure that the information that he obtains during his risk assessment procedures is relevant and reliable. So let's now have a look at the different levels of risk identification and assessment. So when the auditor performs his risk of material misstatement assessment, he will firstly assess the risk of material misstatement at the financial statement level. That means it will affect the financial statements as a whole, and therefore it will affect many assertions. In this case, a risk of material misstatement will require an overall response that should be formulated by the auditor to make sure that the risk is addressed correctly. So when you assess the risk at the financial statement level, it might be that some individual assertions are also affected for specific line items in the financial statement. To this, we will refer to the risk of material misstatement at the assertion level. And the assertions that we identified are referred to as relevant assertions. And the line items that we identified are referred to as significant classes of transactions, account balances, or disclosures. Okay, so it's just important, make sure that you understand this terminology when we refer to it in questions, so that you are able to know what is required of you. For risk identified at the assertion level, the auditor will have to formulate further audit procedures to address the risk. To illustrate what this all means, let's have a look at an example where we can identify a risk at the financial statement level, but which also is applicable to the risk at the assertion level. Okay, so let's say, for example, we identified the following risk. The AFS may be material misstated due to fraud, as management's bonuses are based on a good performance of the entity. So the risk here, the reason why this is a risk is that it might be for management to show that the entity is performing well, that they would like to show a lot of assets and revenue and less liabilities and expenses. And therefore, there is that risk that they might manipulate the financial statements to look good. So in general, if you look at this, all the assertions and classes of transactions and account balances are affected. But as we said, also at the assertion level, it may mean that only certain assertions and classes of transactions and account balances are affected. Okay, so this is still a little bit vague. I think let's drill more down into this example to illustrate it. So as we said, in general, there is a risk that all assets and revenue might be overstated. But if we drill down into the financial statements, what do these consist of? So, for example, account balances such as trade receivables or inventory are specifically at risk, and for revenue, sales might be overstated if it is a retail company. So, when assets are overstated, the relevant assertions that can be identified is existence and accuracy, valuation, and allocation. The other assertions, such as completeness, does not apply to overstatement, and therefore they're not relevant. For revenue, the applicable and relevant assertions will be occurrence and accuracy. Okay. Then if we look at liabilities and expenses, so this is where there's a risk that they might be understated so that the performance also looks good. So once again, if we drill down into what this include, I can think of trade payables on the liability side and maybe cost of sales on the expense side that might be understated. The relevant assertions that can be identified when there might be a risk of understatement is completeness and accuracy, valuation and allocation for liabilities, and completeness and accuracy for expenses. The other assertions are not seen as relevant because there's not that risk involved that they might be under. The risk is not around those ones. I'm talking specifically about presentation and disclosure and cut off or so. So for this, for liabilities, it's specifically completeness, accuracy, valuation and allocation. And then for the expenses side, which can be identified as something like cost of sales, it can also be completeness and accuracy. So can you see how important it is for you to understand what your assertions refer to? Therefore, make sure if you don't understand them and you don't know what they're all about, make sure that you refer to paragraph A190 of the revised ISA for the definitions of those assertions, and make sure that you differentiate between the ones for classes of transactions, which is typically your income statement items, and then also for your account balances, which is typically all the balances included in your statement of financial position. Okay. So let's take our example of the risk identified one step further. So remember that I said that the risk of material misstatement consists of two components, namely your inherent risk and your control risk. You always have to assess your inherent risk first before your control risk, according to the new ISA. So the risk identified in the example relates to inherent risk. And we determined this by looking at the 5 different inherent risk factors. So there are 5 inherent risk factors according to the new ISA, namely complexity, subjectivity, change, uncertainty, and susceptibility to misstatement. So to understand what each of them are all about, you can refer to my explanations included in this slide. I would also advise you to refer to Appendix 2 of the revised ISA for some good examples. For example, in the appendix, they will explain to you what types of risks can be included as part of complexity. If I look at the appendix right now, one of those examples can include operations that are subject to a high degree of complex regulation. So as soon as we give you a scenario and we describe something to the effect that there is really difficult regulation, complex regulations that the entity needs to adhere to, you can immediately, in terms of the inherent risk factors of complexity, identify that there's a risk of material misstatement present. Okay, so the list goes on. If I can maybe just also have a look here at, let's for example also see in terms of change. For example, maybe in a scenario we would say that the company expanded into new locations. So that is listed as a part of inherent risk factor of change, and then you can also immediately identify that as a risk of material misstatement. So I really want to encourage you, refer to Appendix 2, as there's some nice examples and it will really assist you when you work through your scenario, when you identify your risk of material misstatements. So let's just think back to our example that we had. In that case, the inherent risk factor that could be identified relates to susceptibility to misstatement, which refers to something that is likely to take place and will be difficult to resist. In other words, management might really want those bonuses, and it is therefore very likely that they might manipulate the financial statements. So whenever you look at inherent risk, you have to take the likelihood and magnitude into account. So the likelihood will refer to the possibility of the misstatement, which we already said that there's really a high possibility, and the magnitude will refer to the quantitative, the value in other words, or the qualitative, the nature factors. So in this sense, it's also because there's fraud relevant, so there's also a very high magnitude. So based on this risk can be placed on a higher spectrum of inherent risk. Okay, so as we mentioned, the risk in the example can be placed on the higher spectrum of inherent risk. More specifically, it will be placed on the upper spectrum of inherent risk, and those risks can be referred to as significant risks. And they will always require a more specific response. Also remember that if you look at the definition of significant risk, that all risks due to fraud, as in the case of this example, or involved related party transactions are automatically classified as significant risks. So let's just quickly summarize our assessment of risk. So we can conclude for the example that the inherent risk factor is present for susceptibility to misstatement. The likelihood, we explained that it's very possible. And in terms of magnitude, it's relevant due to nature because there's fraud present, there's manipulation of financial statement figures present. And then also we can classify any fraud-related risks as significant risks, and those will typically place on the upper end of the spectrum of inherent risk and require a specific response, specific audit procedures that should be formulated. So up to this point, we discussed all the issues related in terms of inherent risk. But remember, as we said, there are also other components, and the two components are inherent risk and also control risk. And the auditor also needs to look at control risk. Okay, so the question that the auditor should ask himself when it comes to control risk is, firstly, will he test the operating effectiveness of the internal controls? So if the auditor decided in the planning stage that he wants to test the operating effectiveness of the internal controls, you should assess control risk. And you only test the internal controls if you expect them to work effectively. Okay, and that will mean that the auditor typically already had a look at the internal controls in his understanding of an entity, and when he obtained understanding of the design and implementation of controls. Okay, so that's the first part. If he wants to test the operating effectiveness of the internal controls, he needs to assess risks. But if he decides not to, to test the operating effectiveness of the controls, control risk will be assessed the same as inherent risk. For example, if your inherent risk assessment determined that the inherent risk is high, then your control risk will also be high. And this is only like this when the auditor um, is not testing the operating effectiveness of the internal controls. So what now? What happens after finalization of the risk assessment procedures? Then the new ISA 315 standard requires the auditor to stand back and consider whether he has sufficient and appropriate evidence. If he is satisfied, he can design the nature, timing, and extent of audit procedures. But if he's not satisfied, he needs to perform additional risk assessment procedures until he is happy. Okay, so the stand back requirement is new and very important. Then also, remember, as with all your audit procedures, it's very important to document everything. For example, include your results of the identified and assessed risk of material misstatement, your significant risks, your discussions that you had with management or maybe with your team members, your rationale behind the significant judgments that you made, and how you exercised your professional skepticism. All of that needs to be documented. So that brings me to the end of this presentation. I hope you learned something. Please refer to the activity in your lesson to illustrate some of the concepts that we discussed, and then take care. Thanks.